First rates, and the first rates are, it's a rub of green for the Nifty. So we lost 100 points yesterday, we've regained a quarter of that. Breadth is looking phenomenal. The IT index, it's going to limp back, it's going to crawl back, but it's a rub of green nevertheless. I can see some, block deals suddenly. There is something in quick heal technology, not sure why, but yeah, I can see a block deal there. I see some volume action also picking up in names like Bank of Baroda. I can see that there is a solid price action which is visible in BHEL. You've got Precision Crankshaft, a stock where Vijay Kedia I think has increased his stake there. TV18 numbers, they continue to disappoint. The stocks now really at the lower end of the bracket, so to speak, at 29-30 rupees. You've got Bank of Maharashtra, which is looking okay, but Infosys, that's where the puck essentially moved yesterday, and it's a rub of green for Infosys. But 7 rupees after a 10% decline is more like a cat bounce or a dinky move. I will not read too much into it. But Reliance is holding nice and steady. Angel One is holding nice and steady. Just Dial post numbers is holding nice and steady. The market is showing signs of a comeback, and there you go. Tata Motors now jumping all the way up to 475.
Yeah, those are a couple of stocks which are active in trade. Let's see what Infosys is up to, what any HDFC Bank is doing, where these stocks have settled in. Some of the other IT majors though are seeing some respite come in. HDFC Bank flat, marginal green for Infosys, for Tech Mahindra, for HCL Technologies. So it's a bit of a relief. At least they've managed to stall the fall. What are Nestle, SBI, ITC up to, considering they were the ones which really pulled up the Nifty from those session lows? The traction on some of these FMCG names surely continues. Let's see what ITC is doing after making it to that 400 rupee per share mark. ITC 398 is where that stock is, just marginally soft as we speak right now. Bunch of other names which are going to be in focus. Hathway Cable, the EBITDA margins have plunged 32%. Quick Heal, the revenues are lower by 52.5%. There is 361 as well, wherein just yesterday FIH Mauritius Investments sold about nearly 50 lakh shares in a block deal. TV18 Broadcast Nikon just highlighted. The numbers are extremely poor. Tata Chemical, the company has cut light and dense soda ash prices by 3 to 4% across the country. Tata Chemicals as well, gaps down about 3% as we speak right now. Poonawalla FinCorp, this has been very actively traded off late, and a couple of block deals as well. And we told you first at TT Now that Sanjay Chamblia has actually sold about nearly 1% stake at a price point of 290 thereabouts, 0.5% higher for Poonawalla FinCorp. Jubilant FoodWorks, Coca-Cola India has acquired that 15% stake in its arm, #loyalty. Now the correlation here is that Jubilant had acquired, remember, 35% stake in #loyalty in about 2021. Z, Oppenheimer has sold about 5 crore shares. There's Just Dial, the revenues have come in solid with an uptick of 39.5%, and Angel One numbers as well are looking pretty strong. Just Dial has gapped up 6%, Angel One as well holding up nearly 5% as we speak right now. Kunal, at least we managed to stall the fall from yesterday, but can we build on to gains? Can we inch up and close firmly above 17,800?
I think, Aisha, it's a good start, and I would say even yesterday was a decent day for the markets because most of the selling was on the back of Infi. But I think devoid of that, there were very good stock-specific recoveries which we'd seen yesterday. The market breadth was also very strong. Today also it's very, very similar in terms of the overall market view. So would be bullish on the indices and have a bullish stance on the Nifty specifically, because that's an index which is relatively underperformed. Now the stock which I would look to trade in the open and would recommend would be AB Capital. I think it's a very interesting chart in the making. Already trading at a fresh 52-week high for itself, breaking past about the 160 mark. Looks extremely attractive on the charts and would be bullish on this name.
Right. Nooresh, what about your first trades?
So continuing to stick with GAIL, that's a stock which looks interesting. The stock has hit a new GAIL and Indian Hotel. So GAIL is something which has hit a new 52-week high on a dividend adjusted basis. Hotels as a sector looks well. Indian Hotels would be the next one, which could break out in the near term.
All right, let's take a conversation forward. Vetri Subramaniam joins us. Let's understand from him what he makes of the current market setup. Is this a good time to increase your exposure to equities, given that Nifty in last 12 to 18 months has given no returns? Vetri, good morning. Thank you for joining us. Vetri, for a market which was looking dull and lull, there were concerns on the local front, on the global front. Have things ironed out now? Whether it is local issues like inflation and Adani stock sell-off, or global issues like US regional banks?
Yeah, good morning, Nikunj. Good to be here. Well, always something going on in the market, Nikunj. If it isn't one controversy, it will be something else, or it could be what central banks are doing. So there's always some controversy going on, and that dominates the narrative. But really, I think, the metric that I would always recommend to investors to focus on in terms of their view on an asset class is valuations. And I think, as you rightly pointed out, with equity markets having gone nowhere for 18 months or more, in effect, valuations have derated because remember, earnings have gone up over the last 18 months quite significantly. 18 months ago, valuations were, I would say, very much in the expensive zone. Today, we are still not cheap, but at least we've pulled back into the comfort zone. And therefore, our recommendation to investors would essentially be that they could continue to stagger their investments. We aren't really blinking green as yet because we haven't really gone into cheap territory as far as valuations are concerned. But this is an attractive area. It gives you some comfort to stagger your investments.
Vetri can't get over the howler that Infosys was, and there has been serious value erosion as well. We were just looking at the PE multiples from the peak and the way they, have collapsed since then. But do you find merit in buying IT at all right now? And more importantly, do you think this is a sector-specific issue or Infi-specific?
Good morning, Aisha. Well, I've been tracking Infosys it's pretty much been a company that's been around all my career. And it's always had this habit of, surprising people very sharply, both to the upside and to the downside with their earnings reports. So it felt like I'd been transported back to another era when, the stock behaved the way it did yesterday. I think it's sort of early days at this point, Aisha, in terms of whether this is, company specific or sector specific. None of the commentary that we've been picking up in recent, weeks, months with the IT sector companies suggests that there's a significant setback at a sectoral level, and the company did call out some specific issues that they were experiencing. I think my operating premise would remain that I think the IT sector is sort of emerging into the post-COVID era on a very strong footing in terms of the growth visibility that it has relative to the kind of run-up we had maybe during the period 2014, 2020, which was a very sober era for IT, so to speak. So, incrementally, we would be a lot more positive towards IT. You're right about the valuations. They were super rich 18 months ago. I hadn't seen those kind of valuations for maybe a decade or more. But I think it's now sort of pulled back to still above average, but again, sort of drifting into the comfort zone. The underlying premise, as I said, is I think the IT sector is coming out of the pandemic era on a much stronger footing in terms of the revenue tailwinds because of the way their business model looks, because of the way their clients are looking to spend budgets. Now, there could be some tremors in the near term. We've seen this in the past as well when economies are going through uncertainty. But I think the structural tailwinds are strong. So I would tend to look for buying opportunities in IT over the rest of this year.
Let's understand the construct of IT and let's take the clock back pre-COVID. This sector was growing in the range of about 8 to 10%. That growth has come back. The valuation multiples for some of the stocks which they currently are commanding have gone back to pre-COVID levels. So looks like COVID has come and gone and the sector is back to square one, 8 to 10% growth with P multiples of 15 to 20 times depending on the company you track.
Exactly. So, as I said, Nico, we would tend to look for buying opportunities in IT. No doubt yesterday's earnings, last week's earnings number were disappointing, but really our thought process would be that IT has the structural tailwind and there will be an ability to play that. Now, we'll have to figure out which company executes and is able to benefit from those tailwinds the best. But we do think there is an opportunity this year to be accumulating.
There's one bit of a surprise, which Vetri, which is at least something which I've been thinking through. That if I look at the outperformance in last 1 year, ITC right up there, followed by names like Britannia and HUL. Now, at a time when market has taken a decisive relook at value stocks, and cheap is certainly attractive, why have some of the consumer staple stocks which are expensive are still hogging all the limelight? They're owned by FIs are selling these expensive stocks, yet they outperform. Commodity prices under pressure, yet these stocks are doing well. Am I missing on something? Please enlighten us.
I wouldn't read too much into that, Nikunj. These kind of things keep happening. They will surprise you. The market's never predictable, so it's always going to surprise you with something or the other. But maybe it's also been a little bit of a flight to safety given all the other pressures that we've had in the system recently. But I do think that one of the things which has sort of started to gradually, the pendulum is starting to turn, is that I think the sort of period of the sharp increase in interest rates, which we've seen over the last, again, 12 months, both in India as well as in, by global central banks, is now behind us. And I think what this does is that once you raise the cost of capital so aggressively, the focus has to come back on businesses, not necessarily with blow the lights out in terms of return on capital, but they've got to have some respect for cost of capital. And I think, therefore, some part of the value trade, which got a very aggressive bid somewhere during the Russia-Ukraine conflict and thereafter, is going to start to run into headwinds because many of those businesses don't actually generate a high return on capital. They caught a tailwind from commodity prices, supply chain breakdowns. But I think in a higher cost of capital regime, which is where we stand currently, I do think some of those business models will come under pressure in terms of valuations. Whereas the higher ROC businesses, I think the setting is slightly more neutral for them to.
Hi, morning. Wanted to get in your take as well on the capex cycle because we were just talking about, Tim Cook's visit to India, the manufacturing renaissance really picking up. And this is a theme that a lot of experts have been very bullish on. How are you looking to bet on the capex theme in India?
That's an interesting question. I think certainly when I think about the capex theme in terms of the initial conditions, it's extremely favorable. Right, bank balance sheets are the strongest that we've seen in a long time. Yeah, some pressures in terms of their credit deposit ratios, but in terms of their risk appetite or willingness to grow credit, a strong balance sheet is what drives that appetite, and therefore we have that in place. We also have some of the strongest corporate balance sheets that we've seen going back, almost to the era of 2003, 2005, when balance sheets were very, very strong. So I think the initial conditions are there. But I'm yet to really see, in my opinion, a very strong pickup in appetite for corporate investments by, when we look at the aggregate data. Hard to put my finger on what is holding it back. But maybe some part is animal spirits. Remember, we are going through unprecedented times in terms of the increase in cost of capital. We are looking at a fracturing of global supply chains. Companies are having to reconsider what it means when they operate in this kind of an era. So if I were to put my finger on the missing element, I think the missing element is actually the animal spirits of corporate India. I don't really see the kind of animal spirits we've seen in the past, which is what has driven extreme capex cycles. Now, replacement capex cycle will obviously continue. We are a $3.5 trillion economy. The investment rate is well above 20%. So it's not that no investments happen. It's just not clear to me that we have a significant acceleration happening. And that's simply because the entrepreneur animal spirits, I think, are the missing ingredient.
Tata Steel to raise $400 million in offshore green loan. Now remember, some of these companies are now getting a lot of green loan. I mean, ESG, green loan, better coupon rates. Vetri, on a really, since the news is there, so I'm going to change the topics here. 2 years ago, no institutional investor wanted to buy anything which had coal, tobacco, cigarettes, liquor. Guess what? ITC at an all-time high. Coal India is rocking, NTPC is marching higher. Where are all the ESG proponents?
Well, the ESG proponents may well be holding on to their positions, though very grudgingly, because they're seeing the other side of the market do well. I think there is a bit of a conundrum over there. But, I think the pressure that we see, particularly from global investors, in terms of their unwillingness in many cases to look at areas which they now see as being, challenged and threatened, is for real. And the point that I'll make over there, Nikunj, is that yes, the world still will need fossil fuels. It still needs cement. It needs its steel. But I think the challenge when we look at these companies is that we have to start to now worry about how much regulatory pressure might come to bear on them in terms of raising pollution standards, in terms of meeting much stricter, greener norms, in having to invest just to replace a fuel source without necessarily a better selling price. So a lot of the investments that these companies have to make might not actually create incremental shareholder value because they're only having to replace their existing business model with a much costlier business model. So I think there are some genuine concerns, but you're absolutely right. There is a conundrum here that we haven't yet necessarily found the alternatives. But playing those cycles may be tricky, it may be challenging, and they could be very brief. So I think each investor will have to decide what actually is their tenure, what's the kind of period they're looking at, what's the kind of thought process they have. And I think many of the longer term investors will stick to their thought process of saying we don't want to take the risk associated with the disruptions that business models are likely to face because societies, governments, and regulators are forcing companies to go greener, but it's not that they will make incremental return on capital for the investments that they have to make.
Prithvi, always lovely to connect with you and look forward to certainly much more of you going forward.
Thanks, Nikunj. Thank you.
You got a nice little rally in, Jubilant Food. I don't think it's got to be because Coke's invested in a small subsidiary. Coke has made a small investment where Jubilant Food Work also had an exposure. No, I think it's beyond that. I think markets are normalizing. A lot of FI-dominated stocks which sold off, they are making a comeback. I mean, think about it. If that was such a big story, then why Zomato stock has not fallen? I looked at Zomato yesterday. Today I have not checked. But yesterday it recovered from the day's low. So no, it's not going anywhere. It's not fallen. So Coke buying into a food delivery company, markets are saying it's not competition. Until and unless Jio does something, markets will not take it seriously.
Also because Thrive, which is #loyalty's platform, is just really minuscule.
Exactly.
It's not in pan-India.
No, the idea is that here's Coke and Coke has taken a stake. If Coke has taken a stake, they have the ability, muscle, willingness, brand and the reach. So is there going to be a third entrant in the entire food delivery market? And my answer to that is no. It has taken $5 to $6 billion or $6 to $7 billion for Swiggy and Zomato to reach what they are. This is a business which needs $5 to $6 billion totally. And today you add back inflation, it will be much more. And if they have to gain market share, they have to be far more aggressive than what they were when the businesses were starting.
Coke will not get PE money.
Coke will not get PE money. This is pure PE money. And today I don't think even Google today or Alphabet today is trying to cut cost to please their shareholders by not giving laptops to employees, by cutting down on freebies. The Google campus, I've been told, in California is almost like a 5-star. I've not been there, but they are cutting the freebies.
Even the one in Delhi is.
I haven't been there. Google's never invited me. So maybe one of the days. Abneesh Roy joins us now, and we're going to talk about ITC with him. ITC stock hit a record high. Is there some more steam left? Abneesh, good morning. Thank you for joining us. ITC at an all-time high. And if I compare valuations of ITC with a Nestle or a Britannia or a HUL, looks like it is still very cheap.
Yes, good morning and thanks. Yes, we have a strong buy on ITC. I take the point that it is at a 52-week high, and last year also, if you remember, in the Nifty, ITC was among the best performing stocks, and we expect that to recur this year also. In fact, in our model consumer portfolio, we have a 30% weightage on ITC, which is the highest along with Godrej Consumer, and we also like Britannia and HUL. So what we like in ITC is clearly even in Q4, we expect double-digit volume growth in cigarettes to happen. And you see a 4-year CAGR in Q4 and Q3 it will be fairly similar. So they have actually continued to do quite well. So legal cigarette industry is gaining market share from the illegal, which is still around 23% of the market. But illegal is losing market share because of the rational tax policy. Also, we expect that in FMCG, just like other companies, ITC's gross and EBITDA margins will also start expanding, improving from Q4, and FY24 should be a good year from a margin recovery perspective. Slight issue will be in their agri business, because agri business last year in Q4 had a very high base. So there'll be some dip, but that's a commodity kind of a business. The key businesses for ITC are obviously cigarette and FMCG. So the market is liking that for 3-4 years. Government has shown very rational tax policy. And now we'll also see how the value unlock happens in the hotel business. That is something which will again show that the focus of the company is more on the cigarette, FMCG, those kind of stronger return ratio businesses.
Sure. You know, the other thing I also wanted to talk about, Abneesh, is that what happens to valuations? Because we were just looking at the peer comparison, and valuations, even at this all-time high on ITC, are still very, very attractive. So even at 400, does it become a buy?
Yes, it is definitely a buy. You're right that when you compare ITC's valuation with the consumer staples, you will see that ITC is still quite attractive. But you also need to see how cigarette stocks globally are valued, because ITC is still 80% of the profit is still coming from cigarettes. So that is something also we need to take into consideration. But given the global uncertainties, and yesterday we saw the tech sector getting impacted, we also saw that even domestically the startups and a lot of the other kind of discretionary businesses are getting demand slowdown. In that scenario, ITC with such high predictability of the earnings, very good dividend yield also, and the kind of value unlock they are talking about in the hotel business, I would say that those triggers clearly remain. So FMCG should do well as a sector, and then ITC clearly should be among the best performing stocks in that pack.
What about the outlook when it comes to the hotel business as well for ITC, Abneesh? Because now we're starting to see accelerated growth there as well, which, you know, a lot of people tend to ignore when looking at ITC from a holistic standpoint. Do you think that that is going to remain a key trigger?
So hotel business, if you see, ITC is one of the key hotel players in the country. But in the overall target price, cigarette and FMCG are the bulk. So the hotel business doesn't really contribute too much from a target price perspective, but the intent of company is very clear. Last few years, they have said that they will focus on the management contracts rather than doing too much of investments on their own. Of course, some marquee properties in key cities will continue, but the whole idea is to have a more focus on management contracts that will improve the return ratio, because hotel business intrinsically is a low return ratio business. But what management has highlighted also is the value unlock here in hotel, and that is something investors will like, because in ITC it's a very diversified business. So it's more of intent on value unlock rather than the hotel high growth numbers which you highlighted. I don't think it impacts too much from a target price perspective for ITC.
Okay, fair enough. Just wanted to understand the overall outlook as well in terms of the SOTP valuation for each of the businesses as a percentage of the total value. Cigarettes, of course, have the mammoth share at about 58%, FMCG 26%, hotels, we just discussed it, a meager 4%. Just wanted to understand what your outlook is in terms of how each of these businesses really could perform, paperboard, agri, or even ITC Infotech.
Yes, so on the key businesses which you also highlighted, cigarette and FMCG, we are quite positive in terms of outlook in FY24. We expect double-digit earnings growth for both these businesses, and we expect good margin recovery for the FMCG business, which should drive a strong double-digit earnings growth in the FMCG part of the business. Even in cigarettes, we expect double-digit earnings growth driven by a healthy volume growth and a price hike of around 2%. On the rest of the business paper, again, ITC is quite well placed in the mid and premium, and there also we are seeing slight deflation happening because the raw material side has corrected. So you will see that the sales growth number and slightly on the margins in Q4 also, there will be some pressure, but that's because there is a correction in the commodity cost for paper companies. Agri is based on the macro, based on how wheat production is, how the inflation is. So that will be linked to how government policies are. Currently, wheat exports is banned. So ITC, of course, is doing a great job in terms of the tobacco and other commodity exports. But wheat exports last year had done really well, which currently there is a ban. So that is something we need to watch out for. But overall, definitely tech industry also is facing some headwinds, as we have seen in the Infosys results and TCS results also. So that again is not something which is really going to be a big trigger. My view is clearly that cigarette and FMCG, which are the bulk of the business, is going to see a great year in terms of the FY24.
Abneesh, what happens with Reliance's foray now into more regional FMCG brands? They're planning to partner with 10 million merchants, we understand, over the next 5 years. They're looking at, or rather the recent acquisition includes, the likes of Lotus Chocolate, Socio Hajuri, a partnership with Maliban as well coming in. What happens then to the domestic play? I mean, whose market share do they eat into with this?
Sure, good question. And in fact, we released a very detailed report on Reliance FMCG yesterday only. So one thing is, yes, anything Reliance does, the other FMCG players and analysts will see very closely, very seriously, because Reliance has shown that they can disrupt a sector. Having said that, in FMCG, the disruption is very rare by a new player, because here brand loyalty, the distribution and the technological know-how and the data which now all the large FMCG companies have, it has become now very difficult for newcomers to really disrupt the industry. Also, we have seen that D2C startups in FMCG are also now having a very tough time, and we have seen the listed FMCG companies also acquire some of those, and that again will help them in terms of market share. So I will say that in most of the personal care and even in food, say biscuits and chocolates, it will be very tough for a new player to have a big dent in terms of market share. My sense is Reliance knows all this, so they will also pick and choose which battle they'll focus on. So, of course, commoditized kind of FMCG, where, say, Adani Wilmar has a good play, there the market share of the organized players is fairly limited and the opportunity size is very large. And being India's largest modern trade player and a very strong e-commerce grocery player also, Reliance already has a right to win in those kinds of FMCG, which are a bit more commoditized. In the pure play FMCG, I think Reliance will do well in the namkeen and in the surface cleaner, for example, because there again consumer is quite happy to switch if there is a affordable pricing. And there, in fact, in some of these categories, Reliance has done well in their own private label business in the modern trade. But I would say that in personal care, soaps, and a lot of the hair care, etc., I think it will be very difficult for new players to get market share from incumbents because of the reasons which I mentioned. In Kirana, if you see, shelf space is a big challenge. So, and we have seen Kirana lose a lot of market share to the modern trade players, and Reliance obviously is the number one there. So that again, we need to see how easy it will be to get shelf space. Here, product differentiation is key. And one more last point is, if you see, even in soaps and detergent, we have seen that HUL has done quite well, has gained market share over longer time frames, because HUL's pricing, because of the scale and because of global sourcing, and then they have all three subsegments being very strong, lower end, mid end, and the top end. Again, it's not easy even in these kind of products. So I will say Reliance can get a lot of scale over a 4-5 years time frame, but in the pure play personal care and even in the biscuits and chocolates, I would say it will be tough. One interesting battle will be Cola, because their Campa Cola is a decent brand. And of course, Reliance has acquired a Gujarat-based business also. So that is looking interesting. Here, challenge for Reliance will be putting up Visi coolers in the shops, and second, tying up with the manufacturing, because this is a high volume The logistics cost has to be kept low. Those are the challenges in my view. But interesting times, I think for media companies, this will be a good time that you may see advertising in some of these categories increase because Reliance entering into those space.
All right. Appreciate your time and thank you for joining us. The discussion was on ITC and we spoke about how Reliance is moving into different brands and the impact it could have on the Indian advertising market. But the story today is Apple. Apple stores are set to open and this is the first Apple store which will be opening in Mumbai at BKC. And typical of all Apple stores, well, when they open, the presence is felt. The excitement is palpable. Aishwarya, my colleague, is at the Apple store, which is set to open at 11 o'clock, and the queues have started at right 9 in the morning. Is that a real queue? I mean, is there a big bazaar sale there? Today, Apple, mein whatever you buy, you get a discount. Why is there such a big queue outside?
That's true. Excitement is palpable and looks like for the public standing here and the crowds who have lined up outside the store. The Apple store is the apple of the eye for the day. And you know what's special about today is that Apple is marketing this store as a very dynamic store. Their marketing is it to the creative economy as such. And they've held a lot of sessions today. You know, they've called artists, musicians, painters, all of these. What they aim to do with these sessions is to attract more and more creative consumers, videographers, photographers, artists, all of that. And the excitement is definitely palpable. Let's go across to some of the people lined up here. Hi, what's your name? And what is the one Apple product you're hoping to buy today? And why are you buying it? Is it because you're from the creative field or you just like Apple products in general?
Hi, so my name is Kushal and I'm hoping to buy the Airpods 3 first for my mom actually.
Okay, but
Yeah.
anything else that you would like to buy from the store? And
No, like
why do you like Apple as a brand so much?
I've been following this brand for like 10 years since 2011 and it's close to my heart, like all the vision and all its culture, it's very nice.
For how long have you been standing in this queue?
Half an hour.
Hi, what's your name?
Hi, I'm Kanchi.
Okay, what's the one product that you would like to buy from Apple today and what's your intention? Like, are you from the creative field or you just want to buy one of the Apple products? Are you an Apple fanatic?
I have been an Apple fanatic for a long time. I have a frame in my study that's a Steve Jobs frame, and it says the Dent course, the quote, and I'm hoping to buy the AirPods.
Hi, what's your name? Do you look at Apple as a status symbol or do you think it's a product that gives you more creative freedom?
Oh, it's best of the both worlds actually, but it is actually a product which gives you more creative, freedom. So you can actually create a lot of amazing stuff that you can post on social media.
Right. When you look at Apple stores abroad, there are thousands of people lined up outside their stores. Although the crowd is not as big as you would see overseas, what I would say is that for some people it's a status symbol, while for some it's products that provide them creative freedom. Back to studios.
We're just guessing as to what is it that you're going to be buying and if you're buying it all or not. Okay, Nikunj, we need to get her AirPods. She didn't hear what I said.
That's her choice. She's a customer.
Yeah,
But as a provider, you should be giving her AirPods.
I think she's using one, didn't she?
No.
no, those are not
wasn't
AirPods.
Well,
Not
anyway.
a true Apple fan, even though I see that iPhone on the desk, which is yours.
No, I don't use iPods. I'm still the old school guy.
Yeah,
Still use
same.
where is my actually connected?
The headphones
The headphones with the wire.
yeah.
Still the old school. Age is catching up. That's what I would say.
Yeah.
Okay, let's take a very quick break then on that note. And the market seemed to be a little bit stable at least. IT has stopped falling, so that really is the big calming factor. See where we go from here. We'll take a very quick break. Come right back with more.
Well, real estate stocks have been, I won't say they've been on a tear, but they've been on some kind of an uptrend. And is the real estate uptick is here to stay? Is it only luxury which is doing well, or now mid-market and low-cost housing also should make a comeback. Let's take the conversation forward with Ghulam Zia, Senior Executive Director with Knight Frank, and Bimal Sharma, Executive Director and Head of Retail Advisory Transaction Services with CRBE. Gentlemen, good morning to both of you and thank you for joining us. Bimal, what is the trend in the real estate market? There is the luxury or the ultra luxury market where every day there is a newspaper headline or a media headline or a DT now we are reporting that a billionaire has bought a new mansion worth couple of $100. Now that's great headline, but that is not India. What is the real India trend?
I think the overall market is moving forward and the sales are happening on all parameters and every segment is working well. It is on an upward trajectory. New launches are remaining steady and it is across the categories, mid-segment, premium segment, all of them are moving forward. Affordable in tune with the same. So I would say the market is still in the positive territory at this stage. And we are seeing more and more launches out of the larger players at this point in time. The bigger developers.
Ghulam, why is that we are not feeling, why is that this year if I look at the trends, the price trend across India are so different? You know, unlike previous real estate cycles where everything goes up together like a rising tide, the price hike in Hyderabad versus price hike in Mumbai and the price hike in Mumbai versus price hike in the NCR region, there is a large disparity. Why is that?
Well, I would not just stop at that. You know, the price rise, say, within NCR, say, Delhi, or within Mumbai would also vary from pockets to pockets. So gone are the days when you used to, see a price rise all across, very, very democratic, all through the real estate market of the country. It is not so anymore. So good developers, good products are in demand, and that's where the price rises would be very visible. And at the same time, there would be, below par kind of products and not very well-known kind of a developer in the same market. Like even in Hyderabad, I can talk about a few such locations or developers where they're not able to take the prices up at all in last 2 to 3 years. In fact, some of the inventory, which is lying unsold for a long time, age of the inventory as a concept also has to be taken into consideration. Apartments which have been sold for last 2-3 years, for example, are not finding any takers. So there, the discountings are also coming in. So overall, the price rise of about 6 to 7% that we see all over, when I take the weighted average, is a reality. The best of the products would perhaps be getting, say, 10 to 12% of a rise every year on year. The top-notch developers that you also talk on your shows and a few of their products also are getting a good premiums. But at the same time, in the same location, you will find some other developers who are finding it difficult to sell and willing to give discounts. So it is not a very, very democratic trend at all. It's product by product and developer by developer that the price rises are experienced these days.
Ghulam, I wanted to get in your view as well, Ghulam, and what the outlook is in terms of the kind of demand trends that we've seen in particular for residential seem to be at record highs this year. Do you think the momentum can be sustained and even rent prices really going through the roof? What's the outlook?
Well, first of all, let me take the second part of your question, which is rent to sale comparison. Wherever the rents are going high, the sales will not go as high. Because why are you renting? Because you don't want to buy today. So the demand for rent shooting up is one thing that is emerging wherever the rental rates are going high. But on the other side, your question, how do I see the market spanning out here? Well, let me tell you, last year or so, and especially last 7 to 8 months, when the interest rate hikes were coming in on home loans, there were a lot of these, the school of thought was very, very strong that the real estate market had its best and now it will fall. But last month on month, I would say in spite of the home loan interest rate hikes touching almost closing in on double digits, we haven't seen any let up or the demand going down or the transaction numbers going down. In fact, even current financial year, current calendar year, Jan, Feb, March numbers are far better. And at least in March, we have seen the best March in last 10 years. So it is continuing. And now that the rate hikes have also started plateauing, last one, we didn't really see any rate hike, is giving some comfort to the supply side, to the developers, that perhaps the worst is behind us. We're not expecting any more rate hikes, etc., or not as deep as what we have seen in last 7 to 8 months. So going forward, if what we have seen in last 7, 8 months has to continue, then the good days of real estate are here. And next couple of quarters, we shall see the transactions going as strong as we have seen in last 2 to 3 quarters.
Okay, taking the same question to you then, Bimal, in terms of the fact that we've seen even the average residential property prices, there's been a meaningful rise, and that's across the major micro markets. How are you seeing pricing really pan out for the rest of the year? And is it very specific to select markets that we're seeing this major jump in prices?
Actually, I would second what Ghulam said. It is very product specific and for specific developers. Now, and micro markets, as I would put it. Every market is different and behaving differently. And depending on the product and the developer, the quality, the pedigree, the sales are moving. And likewise, the prices are moving up. The current sustenance of the demand shows that we will have continued improvement in the pricing as well, that the market will see.
Ghulam, the other thing I wanted to get your take in on was what's happening with commercial real estate. You know, we've been talking about as to how the residential demand has been, but what's happening with commercial real estate? Because, you know, we've seen that there's definitely a shakeout when it comes to the entire gig economy, these new age tech startups, which clearly impacts, you know, all of Gurugram and a lot of Bombay as well. And then how are lease rentals panning out there?
Well, office market has seen the worst days post-COVID, but last year was good, and even this calendar year, the first quarter, we have seen fairly decent requirement and actually absorptions. In fact, you're talking about rental. Let me also say that in last quarter, we have seen rents also inching up. On one side, whether it is the global recessions, at least in the Americas and Europe that you're talking about, or the war, the Russia Ukraine war, a lot of these headwinds, and in fact even the bank failures, there have been a lot of discussions that India will be at the end of whatever office things that we've seen last 2-3 quarters were pretty good. But there's also yet another school of thought which wants us to believe that with so much of choppy seas in Americas and Europe, India will get the benefit of outsourcing, which is also perhaps possible as we go forward. So at least last 2 to 3 months, we haven't really seen any demand going down. In fact, absorptions are improving even in Mumbai and Delhi. Last quarter was pretty good. So net, in spite of whatever is happening, whether it is the banking meltdowns or the startups not really doing too well and so on, in spite of that, at least office markets are inching a bit higher every month on month, and which is heartening because the way things were moving, we first thought during the meltdown of the banking sectors, etc., that impact will be seen. But somewhere people want us to believe that impact of all these things on India will be minimal. India is, I was just reading some stats somewhere, the likelihood of India going through a recession is almost zero. So this is where it is. We have created an economy which is fairly insulated from the global jerks, and hence we want to believe that going forward office market shall continue at least to remain stable, if not show best results as it has seen about last year and a half back.
Up with one simple question: what's happening in the NCR region? I look at the numbers from DLF. They were able to sell a new project which was of about 9,000 crore in 2 weeks. When I speak to some other builders there, Max Ventures, Oberoi, quite excited about what's happening in the NCR region. Is there something very unique in the NCR region which is differentiating itself, Vimal?
In fact, NCR has been always a very strong investor market, and that continues to play the game there. Over the years, with the COVID, things like that, people have actually come back into the market in the last year and a half. Today, we are seeing phenomenal sales coming out of that market, and DLF, as you rightly said, did an amazing. So it comes back to the product. You put a good product in the market, there are more than enough investors and takers, and they will queue up to buy your stuff in the next 2 weeks, or which is unheard of to sell $1 billion in a couple of weeks. but it is possible, as we have seen already.
Okay, and just going to wrap it up then on that front. Thank you so much, gentlemen, for just giving us a deeper insight as to how the real estate trends are shaping up, what the outlook is when it comes to pricing as well as geographical outlook. All right, let's get a move on then. And affordable housing financiers, they're on Morgan Stanley's radar. They've got an initiation on a lot of companies within this space. Let's take it across to Harsh. He has all those details. Harsh?
Well, yes. So one attractive piece that Morgan Stanley highlights is that the total addressable market for some of these affordable housing finance companies is quite large, and hence the runway for growth is large as well. But outside of that, in terms of risks itself, what could the risk be from banks? What Morgan Stanley seems to highlight is that affordable housing finance companies have, or they deal with a customer cohort which is largely differentiated and which is difficult for banks to really penetrate into because of, one, the lower ticket sizes, and second is that the different types of incomes that some of these customers earn, which are largely also in the informal segment. So it's difficult to assess for banks on a quick and an easy basis, and the lower ticket values also keep banks away from some of these customers, and therefore Morgan Stanley believes that affordable housing finance companies will continue to enjoy the kind of leverage with these customers that they currently do. In terms of asset quality, of course, what also Morgan Stanley also highlights is that through COVID, some of these companies have been able to sustain their asset quality, and now as COVID is firmly behind us, their asset quality has improved, and therefore it shows a bit of resilience with regard to asset quality as well for some of these companies. In terms of valuations, they believe that valuations have started to become reasonable, and valuations are one standard deviation below the mean, and even in terms of stock performance, some of these stocks have underperformed for the last 12 to 18 months, and given that rates are now pretty much at peak, these valuations suddenly have started to look quite attractive. So they've initiated coverage on 4 Aptus, Avas, Home First as well as Canfin, and they have given an overweight rating for both Aptus as well as Home First and an equal weight rating for Avas and Canfin.
Harsh, we'll leave it at that. Avalon Technologies, the new debutant on the street, it's listed at just a tad bit discount to its issue price. 1% lower, 431 is where it's currently at. Let's move on then, and let's talk about where the market as well is settling in at. And it seems like the losses are a little bit deepening. It's not a vicious cut by any means, about 54 odd points lower only. But IT actually has, lost its balance really. You thought that it's going to be on a recovery spree, but not quite. Look at TechM, look at what TCS is doing, even SBI, which was a supporter for the markets yesterday, or for that matter, ITC, they've all flattened out. ICICI Bank as well, marginally soft as we speak right now. Look at ITC, gone absolutely flat in trade. And I think the bigger pressure points today are TCS and Reliance Industries. Look at what's happening on Reliance. That's down nearly 1.5%, wherein yesterday it was the one providing cushion to the index. 2340 is where Reliance is, and that's definitely weighing heavy on the index. But let's now also welcome on board Abhishek Bansal, the CFO at Just Dial, who's going to be joining in on the show. Of course, lots to understand from them, given that their margins have risen by more than 200 basis points. It's been a stellar performance, really, and it's managed to beat the analyst estimates for a fourth quarter. But Abhishek, what explains, this kind of growth that you've seen in the margins? And do you think margins of 15% plus are achievable for the financial year, as more sales hiring is being done by the company for the B2B segment?
See, margins have been on an uptick in last 2 to 3 quarters, and they should see a continued uptick in coming quarters as well. So pre-COVID, we used to be at a sustainable 25% plus EBITDA margin, and our endeavor is that sometime in fiscal 24, we should be going back to the same levels. On reported revenue of 845 crores, EBITDA margin stood at say 15.3% on adjusted for ESOP expenses basis. but we collected 945 crores, almost 100 crore higher versus our reported revenue. So to that extent, margins were already higher on cash basis, and even on reported basis, they should continue to see sequential uptick in coming quarters.
Now, Topline has seen a modest growth of 5% on a sequential basis, and the overall there seems to be a short-term pressure on business sentiment because of inflation and interest rate hike. How is the consumer confidence looking like?
Top line, on our top line, last particular quarter on a per day basis, top line sequential growth stood at 7.4%, which, as anyone can understand, is quite healthy in the current environment. So this particular year, overall, our particular revenues grew about 31% year on year to 845 crores. And our collections had a very strong 44.5% growth to 945 crores. So to that extent, so far, business is bouncing back well. And I think we are exiting FY23 on a very strong footing. And this momentum should help us grow our revenues as well as grow our margins in coming year.
Now, wanted to get in an outlook as well, then Abhishek, as to what the key trigger for growth is for the company. Active paid campaigns has been one of those factors, but that growth has come off a little bit into single digits in Q4. Your average realizations are below pre-COVID levels of 18,000 rupees per customer. So by when can we see a catch up to the pre-COVID levels?
So realizations, as I said, on a reported basis, they might seem slightly lower versus pre-COVID levels, but my deferred revenue of over 430 crores, that deferred revenue has a much higher realization embedded in it. So as we move into future quarters in FY24, we will see a realization uptick. Overall, I think top line growth for us will partly materialize, say half of it should materialize from paid campaigns growth, and rest via improvement in realizations.
Right. So could you spell out how much revenue contribution comes from the B2B segment, and with strong sales hirings for this segment, what kind of revenue contribution expectation do you have for the next 5 years?
So B2B segment contributed about 26% to our revenues, and this contribution, say about 3.5 years ago, stood at about 20-21%. So definitely B2B side of revenues are growing at a faster pace, and we expect this sort of trend to continue because SMEs in B2B segment have a very strong need of a digital advertising platform such as ours to get discovered for users pan-India. So basis that, I think this 26% B2B contribution should continue to see uptake in coming years.
Cash development, company has cash levels of about 4,000 crore in March 2022. Is your company looking at some acquisitions to bring synergies then?
So at this point of time, the 4,067 crore treasury is safely parked in mutual funds yielding 7.2, 7.3% returns. We would look to deploy part of it for any organic or inorganic opportunities if they come along in coming quarters or years.
All right, let you go on that note. Thank you so much for taking time out and joining in with that take. Let's get a move on then, and time for Chartbusters. We've got our experts lined up right again, Nooresh Marani as well as Kunal Bothra. Nooresh, let's begin by discussing your chart of the day, Apollo Tyres.
So this has been a stock which has shown a lot of strength, Apollo Tyres, say from 170, 180 levels in the mid of last year. The stock went up all the way to 340. 300 roughly was the resistance, which was the top in 2018. After making that move to 340, the stock has been consolidating between 305, 310 on the downside, 340 on the upside. For the last few sessions, it's been consolidating around 330. A short-term breakout done about 330 today. Eventually, you would expect it to cross 340 and make a move to 370 to 400. 3-month consolidation after that big breakout indicates we could be starting up the next leg up. A risk-reward trade here, a stop loss at 320 and a target price of 370 to 400 in the short to medium term.
Let's find out what Kunal's chart of the day is. Kunal?
Well, it's on Poonawalla FinCorp, one very interesting chart because on the daily time frame the stock has formed a classical inverted head and shoulder pattern. Now the reason why it's very significant is because the bottom for the stock forms closer to that 275 280 mark. This is also the low the stock had made quite a few times in 2022, except for that one break towards the 240 250 mark. Broadly 275 280 has been a good base for Poonawalla FinCorp, and now the stock has completed a formation of this inverted head and shoulder pattern. This is almost a 20-25 rupee point pattern for Poonawalla FinCorp, which means from a potential breakout point of 300, we could be looking out for 325, 330 as a broad target. So I think short-term traders could look to trade on this opportunity. 325 to 330 could be a near-term target cap on the upside for Poonawalla FinCorp.
Okay, let's find out those individual stock recommendations as well. And Nooresh, 2 buy calls?
So first is a buy on Mahanagar Gas. The stock has been on the recommendation list from the time it broke out about 920, went up to 1020 levels, consolidated classical flag formation, and today a fresh breakout and a fresh 52-week high. Expect this follow-on momentum to go up to 1100, a stop loss at 1000. Second is a buy on Sundaram Fasteners, a fresh 52-week high here, a momentum trade, a stop loss at 1000 and target price of 1150.
Okay, Kunal, let's find out your recommendations as well. What is it that you're looking at on the charts?
So, Avan, the first one would be a buy on IRCTC, expecting the stock to start a decent uptrend. It's come back into the thick of momentum in the last few days. I expect a very strong recovery for IRCTC going forward. So, buy with a target of 630, stop loss at 587. And Apollo Tyres is the other stock which looks attractive. Excellent volumes for the stock seen today on the daily time frame. So, would suggest a buy. 345 as a target, stop loss at 322.
Let's take a very quick break on that note with news that we're cooling off definitely. Reliance, of course, is one key pressure point in trade. Some of the IT names as well are once again falling down. So TechM, TCS, big boys like L&T as well are down, and ITC as well is not doing a whole lot. That also is a bit of a laggard today. We'll take a quick break, lots more on the other side.